thank you for joining us for the panel. Our Shark Tank, we're going to present a couple of great multifamily transactions, have a discussion, have a discussion with the audience, have the audience weigh in through a poll, and hopefully get a lot of good information about what's going on out there on the deal side, and at the same time have a little fun at it.
Good morning, everyone. My name is Beardsley. I'm the founder of Lone Star Capital. We're a New York-based private equity company focused exclusively on Texas workforce housing. We own about a $100 million portfolio in Texas, and we have our own vertically integrated property management company based in Houston.
Rob, why don't you start us off with Park and Champion Forest, value add opportunity in Houston.
Awesome. So this is a 232-unit multi-deal in Houston, Texas. It's built in 2000, so it's situated very well as a B plus asset in a solid B workforce housing neighborhood. The median household income in a 1 mile radius is $55,000, and the median home value in a 1 mile radius is almost $200K. So, it's right in that sweet spot for us where we don't want to be in markets that are too hot, where there's a lot of development and a lot of competition. But we also don't want to be in the troubled workforce locations where there's crime and no population growth. So this market is experiencing strong population growth with a projected about 5% population growth over the next 5 years. And more excitingly, the 1 mile radius has experienced 11% rent growth in the last 12 months. And that's a common trend across the country where there's positive demographics that have been accelerated by the opening up of the economy and inflation. And we see this to persist over the next 24 months, though we're not fully factoring that into our model as far as future rent growth. The business plan here is we're purchasing the property at just under a 4.1 cap, which is a very attractive going in basis for a 2000 vintage B-class deal. And the price per unit is about $131 a unit, well under replacement cost, and situated pretty competitively with the sales comps. The value add business plan includes interior renovations where the current ownership, which bought the property in 2014, has done some modest upgrades to about 90 of the units and has proven out a modest rent bump. But we think that the market is demanding more, and we want to take what they've done, build on it across the site, and take it to the next level with granite finishes, tech package, modernizing the paint, the ceiling fans, just doing things where we think we can get the most bang for our buck. On the exterior, it's a pretty clean asset. It's a really green site, a lot of open space, attractive, big pool. So really the exterior is in good shape. The roofs were replaced, all of them except 3 in the last 3 years. And we're planning on just strategically spending dollars on the exterior to amenitize the property. So we're gonna potentially add a package locker or add more pop to the clubhouse space, and just find ways that we can really give more value to the residents. But as far as deferred maintenance, there really isn't any. So we can just focus on value drivers. With all that being said, the plan is to implement that business plan over the next 24 months and stabilize at an untrended yield on cost of about 5.22%. And then we're projecting to exit in 3 years at a 4 3/4 cap rate.
Sounds good. Sounds good. So let's get some questions in here. Why don't we start with Dan? Daniel, how about you?
So you mentioned that there's been 11% rent growth in the market over the past 12 months. What's your forward rent growth assumption?
So baked into our model is a 3% annual rent escalator, and then we're pushing. So that's just annual growth, organic growth, and then from our value add plan, we're pushing headline rents approximately 15%, or about $140 or so.
And what is already in CoStar say that rent growth is going to be over that same period?
Yeah, CoStar's saying over the next 24 months, they're anticipating 10% rent growth.
Got it. So you're well below whatever the third parties. But median income at the property is $55,000, or median income in the 1 or 3 mile radius?
1 mile radius. 3 mile radius, I think, is slightly higher.
And what's the median income of the residents that are there today?
So we haven't performed a full lease audit. We only had a chance to do a spot check, but I guess it's a little bit below that average. So this property is maybe just slightly below the average of the 1 mile radius.
And how much are you planning to invest in the units? How much more rent do you think you're gonna get?
Yeah, so one thing I forgot to mention as part of the business plan is to add washers and dryers across all the units. There's in the kitchen pantry, there's plenty of space to add, washer dryer unit, and the connections are already there. So we're planning on doing that, and then of course the value add renovation that I mentioned previously for a total of about $7,000 per unit, and that's going to yield us taking rents from about $1,050 to about $1,200.
So why is the seller selling if you can just continue their plan and make a 21.7% return? What's genuine? Obviously, it sounds like a great buy for you. What makes them want to transact?
So they bought the property in 2014. I'm sure we don't know the basis, but I'm sure they were able to buy it for substantially less than what they're selling now. And they've, over the past 7 years now, been able to implement their business plan successfully. And so we're being told that it's now an appropriate time to exit. You can't obviously fault anyone for selling right now.
Right, I just want to round trip. So of the units that are unrenovated, how many of those do you think you're going to renovate? What percent? And then what does that do to occupancy along the way?
Yeah, good question. So in the model, we're projected to renovate all of them. So that's inclusive of the 90 partials and then the rest classics. And we want to bring them all up to that premium finish. Now, that's baked into the model because we believe that's the conservative thing to do. And we're also budgeting to do that in case we have the opportunity to do so. However, there's always the opportunity to take our concept, prove it out, and then either sell that as a value add to the next guy after proving out our business plan. So we can do that more quickly, or we can go through our entire value add, which we're assuming takes 24 months. And because we're projecting conservative 24-month period of renovations, we're going to maintain 95% occupancy.
How do you just physically do that? How do you get tenants that are in place? How do you renovate the unit while they're in occupancy?
No. So we renovate units on terms, and obviously in ordinary course, the goal is to maintain as low turnover as possible. But in a situation like this where there's really a lot of value, especially what's happening organically, the property is experiencing 5% pops on renewals and 15% trade outs on new leases. So there's a lot of incentive to not renew, right? Because you have the opportunity to really mark to market as far as what's happening in the market, as well as add value to the units and then push the rents further. So I think you can't go wrong either way by maintaining low turnover and getting nice pops on renewal, or to really force turnover, get the vacancy, and then make that heavy turn to then lease at a higher rate.
So with the light turns that were done, what was that investment and how much did they increase from?
I believe they invested somewhere around maybe $3,500, and they're getting about a $60 increase.
So they were doing half of your renovation plan.
Less than half, they're 140 versus 60, right?
Yeah,
But you're
about
including
$half.
You're including washer dryers, of course, right?
Yes.
Right. And so how can you be sure that your renovation plan is going to work, that the people there can actually afford it, and you won't end up in a situation where you renovate 15 units, you don't get the rent because there isn't the economic prosperity in the area that would fit in there?
Well, we believe by the numbers as far as median household income and projected rents that we're going to still maintain that 30% affordability threshold. So that's one component. But another component is the fact that we can point to rent comps in the market that have what the property currently doesn't have, and then a simple function of needing to fill that gap with our renovations, and then matching the chunk rent and price per foot rent.
I was just going to say, I know because it's in Texas, it's silly to ask about kind of affordable, but I do see something called an LIHTC home concession. So it seems like there is something going on, some program going on. What is that?
Yeah, so something.
How does that work?
Right, something I didn't mention at the beginning is it's a small component of the deal, but the property currently has 44 units allocated to a home program, which is a low-income housing tax credit situation, which burned off in May of 2023. So it's currently resulting in roughly a 4% concession or hit to top-line revenue. And there's, it really isn't a LIHTC or project-based affordable function. It's more, this home concession is really more of like a voucher situation where tenants are able to, you know, get their rent partially subsidized by the government. But as I said, that expires in May of 2023, so that's a nice, further marking this to market and a nice bonus that is baked into the deal, right? You're buying a slightly lower cap rate today, but you've got that upside built in.
It's 4% of the top line, and it's 20% of units, so.
No, it's 44 units out of 232.
Okay, so just a little under 20%. 17%, right? Just, when you said 4% of gross, does that mean that when that goes, I mean, do you multiply it times 5? I mean, how much below market?
I don't know how much below market the units are. I just know that when we are able to bring those to market, it'll be concessions will go from 4% to 0%. Because outside of that concession, there are no concessions.
For the whole project?
Yeah, project level, that's right.
So, do you do those units in a lot more work than the others, or did they fixed up recently, or are they run down?
We don't have it. We haven't had due diligence that.
Can you re-enter that program and get the tax credit?
So that's the thing, and it's interesting, we have been advised by our property tax consultant that there isn't a property tax implication associated with the home concession. So I think, again, it's less of a tax credit situation and more of the owner opted for this program for either to preserve affordable housing or to get more certainty of rent payment, right? Because they've got the parking with the government.
So, when you collect rent from the government, it's a process. How ready are you internally to participate in that process? Especially when you're doing it for a small number of units, it's quite costly. It could be quite costly.
Yeah, that's very true. And as we're in due diligence right now, we have to actually go through a process of getting approved by the city as capable of taking on this program. So yeah, it is more involved. Fortunately, our VP in Houston is has a lot of experience with various affordable programs and project-based affordable housing. And so we have a lot of confidence in that situation. But furthermore, you may also know that Texas has really been a shining light as far as rent relief payments. And we've been getting, on our other properties in Texas, we've been getting paid out very well from Texas rent relief. And we're having some of our highest collection months on record because of that.
Let's go back a second. You're buying this at what cap rate on a trailing 12 basis for replacement?
4.1%.
4.1. And what is your plan to sell? When you do sell, what are you selling at?
4 3/4.
And that 4.1 is T12 revenue over T12 expenses?
It's adjusted. No, it's a good question. So it's about T3 revenue, adjusted expenses for property taxes, our insurance. Everything's going up in Texas. So a little higher insurance, higher property taxes, and then our payroll and expense assumptions.
So you adjust the purchase price cap, and what about the 4.75 that you exit at?
That's based.
Do you again tax adjust on exit or no?
That's untax adjusted, and it's based on our trailing 12 month of the year sale.
You talked about other projects that you've done. Tell us a little bit about your track record in this market, and also who's doing the construction. Is that vertically integrated, or do you outsource it?
So we own 2 properties nearby in the northwest Houston quadrant that we've successfully implemented value-add business plans on of different natures. One was more of a lease-up where we bought a property at 80% occupied. We didn't really spend any CapEx, leased it up and stabilized and refinanced into agency debt. And another project was maybe 3 miles from here in a much worse location, Class C workforce housing, different demographics. And we were able to take that, reposition that asset by increasing rents 20%, raising occupancy from 70 to 90%, and also refinancing out of the bridge loan. Outside of those 2 projects, we own a few other assets in Houston, and our operations are based in Houston, so we are very well positioned to take advantage of this opportunity here. And as far as construction, we partner most of our construction work with a local family-owned GC in Houston.
So you're holding for 36 months according to your plan. Can you give the audience a sense of what percentage of your stabilized NOI increase relative to in place when you're buying in is lost to lease versus the 15% pop in rent versus the 3% market rent growth you were doing?
Yeah, so all in on an untrended basis, our business plan calls for pushing revenue about 16%, right? That includes burning off the home concession, raising headline rents through the value add, and maintaining occupancy where it's at, which is over 95%. So it's a 16% push untrended, and then you obviously layer in the 3% per year escalator, and you're looking at a total NOI increase of somewhere around, low 20s.
So the loss to lease component is relatively small here.
That's right.
And expenses go up 3% a year?
Two. But we did actually this morning sensitize for that, and it impacts the IRR about 30-40 bips.
Okay, so you're looking to raise 90% of the equity, is that?
That's correct.
Okay, and that is, I can't even
Call it 7.7.
The total equity is 37 million? No, 8.6 million, right?
Yeah.
So you'd be 860,000 and, $8 million from an investor. All right, folks, so here's the cool thing. We want you all to vote on this Texas property. All you have to do is send a text message to 318-515-7204, and in the message body, either put in 1 for a vote of yes and 2 for a vote of no.
David, you forgot to ask your favorite question. What's the promote structure?
Well, that's a good point, Michael. Thank you for that. While the audience is thinking about it, why don't we talk about what your ask is on the promote? Okay.
Sure. So, obviously, similar to our other panelists here, we operate under the dual mandate of raising capital through syndication as well as through institutional JVs. So we have experience, working with different structures. So if we were to do a syndication, it would be our standard syndication structure of a 2% acquisition fee, 2% asset management fee, 8% pref, 30% promote over the 8, and a 50-50 over 15. But because we're all such good friends here on this panel, I'm willing to offer you guys a 1.5% acquisition fee, 1.5% asset management fee, a 9% preferred return, a 20% promote over the 9, and then a 60-40 over a 15.
60-40 going to which direction?
40 to the sponsor.
Got it. Okay, so you guys know the deal.
Yeah.
Have folks had a chance to send a text message before the panel starts voting? Any questions on how to vote? Okay. Any questions about the deal? All right. All right, why don't we start off with Dan with you? What do you think? Want to do this?
I'm not going to pay the asset management fee, but otherwise, the thing I like most about the deal is you're going in at a 4-1. I could probably batten down this 26% renovation premium to something closer to 20% and still do okay. And tax adjusted on your exit cap, it's probably closer to a 4.5 if you're underwriting a non-tax adjusted 4.75. It still gives me about 40 basis points of cap rate increase over the whole period. So yeah, I think that sounds good.
I'm with Dan. You're going to walk into our office building. It's going to be shiny. We're not going to pay those rates, when you syndicate. But with a more reasonable promote structure, I think this is a deal that's really interesting. I don't think you're going to be able to renovate all the units as quickly as you think you are. So you're not going to get that pop necessarily for the renovation. But I do believe this market will have very strong rent growth. I think your acquisition price is reasonable. I think your exit cap rate is also reasonable. And I like Northwest Houston. So I think the project from the pictures we saw looks attractive. It doesn't look like you're going to have any of those big surprises on CapEx. Exteriors, roofs, you said, we were renovated or replaced recently. So I vote yes.
So a couple of thoughts. First of all, I've in a decade never paid more than 75 basis points of purchase price on an acquisition fee. So I think 1.5 is really rich. In terms of your asset management fee, I don't mind, but I couple that together with property management. And so long as the two don't go over 4, fine, maybe 4.25 at the most. So there's probably some give and take there. Your rethinking of the promote structure is also amenable.
Good to hear.
So with a couple of changes, I do want to caveat that we don't invest in Houston because we think you have to be local in Houston. It's a very fast moving market. Things change very quickly on you, and if you're not local, you can get caught with the bag in your hands. Anyway, I'm going to ask the guys back there to toggle to our poll and see what the audience said. I can't see. There we go.
Sounding success.
Yeah, a whole 17 people. Well, there's only 20 people in the room.
Not bad.
Anyway, you get your money. You can we'll lock the door. You can get the cash on your way out. You guys can toggle back to the presentation, please.
Dave, I agree with you on a couple of phrases. What is the Texans make money in Texas? So I like the fact that your operations are based there, and then the other is in Texas. The slower they're talking to me, the more I'm getting.
Look, we're just beginning to invest in Dallas and Austin. I think we're far away from getting comfortable with Houston, but again, I think there's a lot of really smart people there, and they're making a lot of